Today, mortgage moves and other news. The DFA Daily to the 18th of October 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the big changes to mortgage rates from CBA, mortgage delinquency expectations, and the strength of the economic rebound as Sydney and later Melbourne reopens. But first, CBA has made one of the biggest moves in months, slashing a mammoth 40 basis points from its basic variable rate. This is thought to be the lowest basic variable rate that the bank has ever offered. Australia's biggest home loan lender will now offer customers with a lower than 70% loan-to-value ratio an interest rate of 2.29%. The LVR of 70 to 80% band rate has also been slashed, with 30 basis points coming off a new home loan rate, making it 2.39%. Higher LVRs get a rate cut of 14 points, dipping their home loan rate with CBA under 3% to 2.99%. Now that move will surely send shockwaves through the industry as CBA rate cuts tend to trigger wider rate cuts from other lenders. But it was not all cuts from the CBA. They've put 10 basis points on their fixed rates at 2, 3 and 4 year rates. The only fixed rate to be lowered was their 1 year rate, which dropped below the symbolic 2% barrier at 1.99%. Analysts are already suggesting that the changes in CBA's home loan rates are as a result of APRA lending regulation changes. While cash rates have remained the same for months, APRA is trying to constrain risky lending via raising the buffer rate against which customers are assessed when applying for loans. With CBA's interest rate call now, they're staking their claim to their big deposit customers who can refinance to this current home loan rate. ING has also made a similar move, with their variable rate going down 25 basis points from 2.49% to 2.24% for owner-occupiers, while fixed rates have all risen. A CBA spokesperson said, "We regularly review and monitor our products. Our competitive home loan rate remains at historic lows and continues to provide value for customers, including a 1.99% per annum fixed rate for 1 year. That's owner-occupiers paying principal and interest in their wealth package. Our customers have access to industry-leading features, including home loan compassionate care, CommBank Green Loan, and Home-In, and recently announced partnerships with energy retailer Amber, property management platform Different, MBM provider More, and fintech startup Kogo." As part of our review, we're changing selected headline fixed rates, taking into account elevated underlying funding costs and the broader economic recovery. We are also updating the discount for eligible new customers across our extra home loan products. We encourage customers to speak with their CommBank lender or broker to see how we can get them into their home faster. Now, the point here, of course, is that this is a really strong indication that the expectation now is that rates are going to rise quite soon. But also CBA wants to stake its claim on the current low rates in the marketplace. So in a way, what they're doing is moving more people into those variable rate loans rather than fixed rate loans. And when rates go up, of course, they can pass that along. Elsewhere, mortgage delinquency rates are tipped to increase moderately over the rest of the year, with Moody's expecting economic aftershocks to linger from the lockdowns. A new report from Moody's has forecast that mortgage delinquencies will continue to increase this year after rising in every state. As reported in Mortgage Business, delinquency rates have crept up across each state and territory over the 6 months to May, according to recent data from Moody's, when it tracks increases across 65 regions in Australia and declines in 22 regions. Across the country, the proportion of mortgages that were more than 30 days in arrears was up by 0.17 percentage points from November 2020 to May this year to 1.61%. The Northern Territory had seen the largest increase in delinquencies from November 2020 to May this year, up by 0.44 percentage points to 2.7%. Victoria followed, up 0.25 percentage points to 1.66%, as well as South Australia, up 0.21%, Tasmania, up 0.18 percentage points to 1.01%, New South Wales, up by 0.17 percentage points to 1.39%, and Queensland, up by 0.12 points to 1.56%. The ACT and Western Australia had more minor changes, up by 0.09 percentage points to 0.75%, and 0.02 percentage points to 2.35 percentage points, respectively. However, each state had declined year on year, with Western Australia showing the largest fall of 0.98%. The analysis also expects the climbing trend to continue into the months following easing restrictions across New South Wales, the ACT and Victoria. Economic conditions will improve as restrictions ease. Nevertheless, the adverse economic effects of this year's outbreak will cause a moderate increase in mortgage delinquencies over coming months, the report stated. Mortgage delinquency rates will only increase moderately over the rest of this year because low mortgage interest rates, the strong housing market and various government and lender relief measures will support borrowers. Moody's noted that Victoria's economy had contracted by 0.8% in the first half of the year, reflecting the effects of the state's COVID lockdowns prior to this year's Delta outbreak. All other states have grown, with the Northern Territory leading the pace, up 0.62%. The 10 worst performing regions for the highest delinquency rates featured rural and regional areas, as well as pockets within Perth, northwest Melbourne, Mackay and Darwin. Western Australia Outback ranked at the top with a rate of 3.14%, although it's down by 1.38 percentage points from a year ago. Queensland Outback had the same rate, which has grown by 0.68 percentage points. And recent data from APRA showed COVID-related loan deferrals more than doubled between July and August, rising from $5.6 billion worth, or 0.3% of loans outstanding, to $11.9 billion, or 0.5% of loans outstanding. Deferrals have been highest in New South Wales at 1.4% of outstanding loans. Meanwhile, data from the Australian Banking Association in August showed almost 24,000 customers accessed hardship support from banks during the month following the 8th of July. The total included around 15,000 repayment deferrals on home and business loans. Hardship approvals and loan deferrals have been more skewed towards New South Wales residents in lockdown. But S&P reported in September that delinquency rates were better than expected given the pandemic, and that refinancing had become a common way for borrowers to self-manage their way out of arrears. And elsewhere, Fitch Ratings says differences in the pace of reopening across Australian states will remain a key challenge for corporate issuers for the remainder of 2021, but strong financial flexibility should provide support over this period and curb rating action, which has remained low since the start of the COVID-19 pandemic. We expect activity to begin to rebound in late 2021 as Australia's two largest cities, Sydney and Melbourne, emerge from pandemic-related lockdowns imposed in the middle of the year to combat outbreaks of the Delta COVID-19 variant. The success and rapid pace of the vaccination programs in the country's two most populous states, New South Wales and Victoria, is driving Australia's transitioning to live with the virus and the reopening of the country. Corporates will need to continue to navigate variations in reopening plans between states and territories into early 2022, although we expect all to reach the government's 80% target of all adults over 18 years being fully vaccinated by mid-December, apart from the Northern Territory, they said. The high vaccination levels should provide businesses with more certainty due to a lower risk of new lockdowns. Post the transition, they expect the results of Australia's corporates to reflect individual fortunes. First half 21 results highlighted the ability of corporates to bounce back from the pandemic-related lockdowns, with the majority of Australia open for the period and industry or company-specific factors acting as key drivers of success. They said the gradual reopening of Australia's international borders will also help to return demand to pre-pandemic levels for most affected states. However, any delay in reaching vaccination targets or the retention of widespread restrictions once the targets are met will weigh on the long-term outlook for Australian corporates. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.